I'm going to talk about our Aberdeen UK Smaller Companies Growth Trust. And here we all are. So this is your smaller companies team, and it's a small compact team, and we're all based in Edinburgh. And what's common about us is that we all run a tried and tested investment process based around quality growth and momentum. And what's different about us is that we're looking for smaller companies in different regions. And for the UK, it's myself and my colleague, Abby Glennie. And we're really lucky to have to be part of a global team where our colleagues are looking for the same type of company in different regions. And that's because part of our even though Abby and I run a UK fund trust, we half of the revenues that come from that trust are invested in overseas. So it's really important for us to have that communication with our colleagues who are looking for companies with the same characteristics in different regions, because it really helps us inform our investment case. So now I'm going to talk to you about our investment process. And we've been running this bottom-up investment process in the UK now for over 25 years, and it's seen 5 economic cycles. And no matter what goes on in the macro, we don't change what we do, because we believe our investment process over the long term delivers fantastic investment returns. Now, last year, it was all about the macro. It was all about the top-down. And in that environment, we really didn't change what we do. We stick to our knitting, and we're using these principles to try and find smaller companies which will grow into be larger companies. So what do? We focus on quality, because we like high quality companies, because smaller companies as an asset class are risky, and we want to run your money in a lower risk manner. And the second part, growth. So we're looking for companies that are in control of their own destiny, companies that can continue to grow in all macro environments. So when things get tough out there, our smaller companies are high quality with levers to pull that they can continue to grow in difficult backdrops. And then the final piece is momentum. So earnings momentum, companies that are trading really, really well, companies that are meeting or beating analyst expectations. And this is our running your winners principle. So for stocks trading well, we want exposure to that, and we'll increase our position sizes to get more exposure to those companies. We have a stock screening tool called the Matrix, which again has been really core to our process for these 25 years. And that helps us in a number of ways. It helps us screen the universe, because markets and companies are always changing. And it allows us with such a small team to stay on top of that. And it also keeps us consistent, so that we can continually have a good check and balance to let you know and to let us know that our portfolio construction has companies which exhibit these 3 characteristics: quality, growth, and momentum. We're long-term investors. So for new ideas, we're looking for around an investment horizon of around 3 to 5 years. But often, because of our process, when we get these stocks right, we keep them in our portfolios. And that's part of the principle where we get our quality growth and momentum stocks, and they can then elongate and grow. And that's how we end up holding them in our portfolios over the long term. Our process places a huge emphasis on backing great management teams, and we really do spend a lot of time with our management teams, really trying to understand what their aspirations are for their company and what it can turn into over the long term. And we're really fortunate through running such large assets in UK smaller companies that our access to management teams is really, really good. We really like founder-run businesses as well, because, like us, they often have a big shareholding, and they think about the long term. So that aligns with our process. And then lastly, valuation aware. Our process is more centered around quality growth and momentum, but certainly valuation is part of our matrix, and it remains front of mind as well. So they're the principles. So this is a quick whistle-stop tour just to let you know of the characteristics that we look for. And that's exactly what we're trying to do. We're using this tried and tested investment process to buy smaller companies today, which will grow into high quality, large ones. Okay, so what do I mean by quality growth and momentum? So quality, really simple. We're looking for great companies. So everything you would expect, great financials, good margins, good return on capital. We're looking for businesses with a big moat, with high barriers to entry or a sustainable competitive advantage. And some of the characteristics which have really shone through, particularly last year in a difficult environment, are businesses with high visibility. So, recurring revenues, subscriptions, repeat revenues. And these businesses have had pricing power and really been able to invest and continue to do well against a backdrop that's been really, really difficult. And like I said, we place a huge emphasis on great management teams. If we not all of our businesses are run by founders, but our management teams will have had a great track record. They'll have seasoned professionals. They've run these businesses throughout difficult times before. And what we don't do, we won't invest in loss-making companies. All of our companies have to be profitable, and we don't invest in companies which are heavily indebted, which have a lot of leverage. We tend not to invest in highly cyclical companies. It's not to say that some of the companies that we have in the portfolio are cyclical, but we tend not to invest in highly cyclical ones. Okay, and then moving on to growth. So we want a company which is in charge of its own destiny. We want a company where it has a number of levers to pull to continue to gain market share. And to do that, you need to be positioned well in supportive end markets. And we're looking for the ability to expand margins. But the most interesting part of our growth bucket there is this ability to expand into adjacencies. So whatever the company's great at, can you do it elsewhere? Can you do it in a different geography or a different territory? Or can you broaden out into a different product line or a different service? And if they can, because they've got the high quality characteristics as well, this elongates our investment case and allows us to hold this company over the long term. And then the final piece is momentum. And this is a company which is trading really, really well, which is beating or certainly meeting analyst expectations. And this is running your winners. So if a company is doing really, really well, we will continue to hold this. And stocks with momentum score really, really well on our stock screening tool, the Matrix. Okay, so the Matrix is a multi-factor model, all based around quality growth and momentum. And the reason why we use this is if you look at the dark blue line on the bottom, that first quintile. So every stock in our universe has a Matrix score. And over the long term, because of the performance of this first quintile here, we know that stocks with excellent Matrix scores outperform. So that acts for us as a really powerful signaling tool, and it allows us to say, don't waste any time doing your fundamental research and meeting the management teams of stocks in the second, third, fourth, and fifth quintile, because we know that they don't exhibit that quality growth and momentum. So what we have is a really powerful stock signaling tool. And it helps us in many, many ways, but the most fundamental way that helps us is in screening the universe. Markets and companies are always changing, and we constantly have that live screen up on our desk so that we can constantly see what companies are worthy of further investigation because they'll have high Matrix scores. It also helps us with portfolio construction as we continue to weight the portfolio towards the stocks with higher Matrix scores. Now, I don't used to go away thinking that we're a quant fund or that we rely solely on the Matrix. It is a great signaling tool, but we overlay all of the fundamental research and the meeting of the management team on top of that. One thing we do like to say is, the Matrix is a tool and it has no emotional attachments. It's never met the company, it doesn't know what they do, it's never met the management team, but because of that, it keeps you objective. So, you can get sucked into top down or what the management team is telling you, but this is something that keeps you back and allows you to remain objective and consistent with the process. Okay, so this is a slide just to give you an idea about what we hold in their portfolio. So this is our top 10. Some of the companies you will know on here, some of them you might not. But what we end up here with through our stock selection process is a really different, diverse list of names. And what I'd like to draw your attention to, particularly at the moment, is this column here, the recent direction of earnings. And you can see that in a very difficult market, which is dominated by earnings downgrades, our process has allowed us to identify stocks who can either gain in-line earning statements or stocks which have been getting upgrades to earnings. And that's what you would expect if we follow a process where we find great companies with quality, growth, and momentum who can execute against difficult environments. And they've, you know, they're trading really, really well against a difficult backdrop. For Imprint today, for example, is that this is a company which is based in Oshkosh in Wisconsin in the US, and they supply branded promotional merchandise. I'm sure you've all got something with AJ Bell on it somewhere in your armory. And today, you know, this is a stock with clear momentum. We've had another fantastic performance from them on all metrics: sales, profits, margin, and we've even had a special dividend from them today. And this is the biggest stock in the trust at the moment, which is executing really, really well against a difficult environment. Okay, if we move on to the process in action. So because we have the matrix, you know, where it's always flagging to us our new ideas, we're constantly seeing ideas for new stocks. And here are a few that we've added recently: Ricardo, FDM, Spirent. So we never have a problem thinking of ideas that we can add to the portfolio. Next column, exit. This will be our sell discipline. So these will be stocks where they're no longer fitting our process. You know, they'll have a negative matrix score. They'll no longer be exhibiting quality, growth, and momentum. And something fundamentally has changed for us. And that will be our sell discipline. You know, we don't work to price targets. We don't work to, I've earned 10% of my money. We exit when we see a change in our investment case. And then the next column, stocks that we've been adding to at the moment, stocks with lots of momentum that are trading really, really well. CVS, vet business. Smart metering does the smart meters that you'll have in your house, which also has a really attractive battery business as well. Lion Trust and Tatton are asset managers, and Games Workshop is a hobbyist business that which we actually went to visit last week. So stocks that are doing well, we will allocate more of the portfolio to it. And then stocks that we've been reducing at the moment. So Bytes, Craneware, and Focusrite are still great businesses, but they've been trending down on momentum, so we will be deallocating from them. Alpha Financial Markets is a position that we've just trimmed a little bit at the moment because of outperformance. Because that business has been trading so well, we've just taken a bit down just to monitor that position size. And then Kainos at the bottom, again, another brilliant business which has been trading well, but we're just mindful of the valuation of that business at the moment. So hopefully this slide gives you a bit of a feel as to how we construct the portfolio. Okay, so this chart maybe adds a bit more color to what Ryan was giving in context at the introduction there. So smaller companies, you know, you really have to have a long-term horizon when investing in smaller companies. Now, it's really difficult to time the market. I think everyone knows that. But what we can tell you here, and to be clear, this is our UK smaller companies OIC, because that has the longest track record. But as you can see, you know, over the long term, investing in UK smaller companies in this process will make you money. Now, if you got your market timing right and you entered here, you know, you'd have made a lot of money. But what we say to you is, you know, it doesn't really matter when you get in. You've got to get in, you've got to hold this asset class for the long term. And we say 5 years. And what we can also say on this chart is, this is our strategy versus the benchmark, is that at no point have we underperformed the benchmark, which is really an attractive testament to the way that we run smaller companies' money within our team. Okay, so why buy the fund? Well, I mean, this is a wordy slide, but what we can tell you at the moment is that UK equity valuations are very, very low. So like Ryan was saying, often people do try to time the market, and this would be a really, really good time to buy some UK smaller companies and hold them over the long term. The other thing we were seeing is because UK companies are derated so much versus global markets, is that people are beginning to start to look at the UK again now. And what we always say, I mean, last year has been a really, really tough year for our process, because it's all been driven by the top down, and value companies have been in favour. And as we've seen, the recovery has been fragile. We've had market turmoil as recently as this week with the SVB and Credit Suisse news coming out, and we just feel like our focus on quality really, really is important in that environment. We're buying high quality companies with consistent earnings profiles, and this over the long term has been a great way to invest in smaller companies. So I hope that's given you a brief, albeit 15-minute whistle-stop tour around our process. I'm conscious that there's been no time for a Q&A, but if you have any more questions about the funds that we run, or the stocks that we own, or indeed the investment process, don't hesitate to get in touch. And I hope that's been helpful.